Let's say you or your parents have a ULIP plan, maybe something from Bajaj, SBI, HDFC, LIC, or whatever. The pitch sounded great back then. Investment plus insurance, market returns, tax benefits, all in one smart product. But now it's been 5 years, you open the statement, see a decent fund value and think, okay, I think it's time to remove this money, but if I do, what actually happens to this policy? We're going to answer that in today's video. Hi folks, I'm Shashank, you're watching Ditto Insurance. In this video, we're going to break down exactly what happens when you withdraw from a ULIP after 5 years, whether you did partially or fully, how it affects your life cover, what IRDAI rules say, and when it makes sense to exit. Now, if you're already confused about your ULIP or thinking of getting out of it and going in for a pure term plan, you can just book a free call with Ditto's advisors for a spam-free experience. Our services are completely free. Book a free call with the link in the description and we will look at your policy together. Okay, first basic ground rule here. Every ULIP in India has a 5-year lock-in from the start date of the policy. Not from when you feel like it started, but from the date printed on your policy document. For those first 5 years, even if markets are doing well and you're desperate for cash, you can't freely withdraw. If you try to exit before that, the policy is discontinued, your money is pushed into something called a discontinued policy fund. It earns a modest regulated return and you only get it back after the 5-year period is over. Your life cover stops immediately, so the real story begins only after those 5 years are done. See, once you've crossed that 5-year lock-in, your ULIP becomes liquid. That means you now have two broad choices. 1. Partial withdrawal. 2. Full withdrawal or surrender. Partial withdrawal is where you take a chunk of the fund value and keep the policy running. Full withdrawal is where you tell the insurer, boss, I'm done. You take whatever is in the fund and the policy, including the life cover, and yes, the life cover ends there. Okay, now let's start with the partial withdrawal because that's what most people think of first. Different insurers have slightly different rules, but the idea is similar. You're allowed to pull out part of your accumulated fund value after lock-in as long as the policy is active and you leave a minimum amount behind. Bajaj Allianz Goal Assure lets you withdraw after 5-year lock-in with limits based on term and fund value. HDFC Life Click to Wealth lets you withdraw, but you must keep at least a minimum balance and often equal to 1 year's premium or some predefined amount. SBI Life Wealth Creator may allow you to withdraw up to 20% of the fund value after the 5th year. So you can treat the ULIP like a semi-liquid investment for short-term needs like education, emergency, home renovation without killing the policy. But here's the lesser-known twist. Partial withdrawals can affect your life cover. Yes, you heard that right. In most ULIPs, your sum assured technically stays intact, but IRDAI rules say that if you withdraw money from the base fund within 2 years immediately before death, the death benefit can be reduced to that extent. Okay, for example, suppose your ULIP has a sum assured of 10 lakh rupees. You withdraw 1 lakh from the base fund within 2 years before death. If something does happen, the effective cover can be treated as 9 lakh instead of 10. Now on top of that, there's a floor. The death benefit can never go below 105% of total premiums paid. So if you've paid 5 lakhs over time, the minimum death benefit must be at least 5,25,000 rupees. Top-up withdrawals are treated differently. They usually don't reduce the minimum death benefit in this way. But the main point is this: you can withdraw, but big withdrawals close to a claim can reduce the effective protection. There are also hard limits on how much you can pull out and how frequently. Insurers typically say you must keep a minimum balance after withdrawal, sometimes 3 times the annual premium, sometimes at least 1 year's premium, sometimes more. You need to be at least 18 to even request a withdrawal. Many plans allow just 1 withdrawal per policy year. Maximum partial withdrawal is usually capped at around 20 to 25% of fund value at a time. Minimum withdrawal might be 5,000 rupees or whatever the product specifies. If you go too aggressive and the balance falls below the required limit, the policy can lapse or stop offering life cover and you convert it into a tired little investment product instead of investment plus insurance. Now, what if you're done with the ULIP and want to fully exit after 5 years? Now, that's where surrendering comes in. In that case, the insurer simply pays you the fund value on the date of processing after adjusting any exit charges that might still apply. Once that money is paid, your life cover ends there. That's it. You're not insured anymore. You can't revive that same policy later. It's a clean break. For someone who's decided ULIPs are not for them and would rather invest in mutual funds or other products, this is the typical path. But the key mistake people make in this is they surrender the ULIP and then forget to buy a replacement term plan. So they walk away from their money but also walk away from their life cover and stay underinsured for years. Now, before we get into tax and process, let's quickly address the what if I try to withdraw before 5 years scenario, because a lot of people get desperate around year 3 or year fear for when they see the markets go crazy. If you surrender before the 5-year lock-in is completed, the life cover stops immediately, as I mentioned. The policy terminates and the fund value after charges is moved to that discontinued policy fund. Now, this DPF gives you minimum guaranteed return fixed by IRDAI, currently around 4% per annum. You don't get the money right away, you only get it after the 5-year period is up. So you're basically locking your money in a low return parking lot while losing the protection. In most cases, it's just better to somehow survive the lock-in and take action after 5th year. Okay, now let's talk about the practical side. How do you actually withdraw after 5 years? Step 1. Check that policy has really completed 5 full policy years from commencement and that it's still in force. All premiums due must have been paid. If the policy lapsed earlier and got moved to a discontinued fund, then you're basically just waiting for the lock-in period to finish and you'll receive whatever is accumulated there. Step 2 is to check your current fund value and NAV through either the insurer's app, portal, statements, or by asking your advisor. ULIPs are market linked, so if you withdraw on a bad day in the markets, you may unintentionally lock in a low value. Step 3. Place the request. You can do this online through the insurer's portal in many cases. Choose partial withdrawal or surrender, enter the amount, verify bank details and submit. That's it. Offline, you would fill a withdrawal or a surrender form, attach KYC, a cancel check, maybe the original policy of surrendering and submit it at a branch. After that, step 4 is waiting for the process. Typically, insurers process the payout within 7 working days if all documents are in order. You'll get an SMS or email confirmation and the money will come into your registered bank account. In case of full surrender, you'll also get a statement confirming that the policy is terminated. Now, let's handle the tax angle because this is where many people get surprised. Withdrawals after 5 years are generally tax-free under Section 10D, but only if certain conditions are met. One key condition is that the annual premium doesn't exceed 2.5 lakh rupees for policies issued after Feb 2021. Another is that sum assured is at least 10 times the annual premium. If your ULIP is smaller, typical middle class size, premiums well below that 2.5 lakh year mark, chances are your maturity or withdrawal amount will be tax-free. But when the annual premium is high and crosses that threshold, the gains from the ULIP can be taxed like equity mutual funds under Section 112A with long-term capital gain tax on profits above a certain limit. So, what's Ditto's real take on ULIP withdrawals after 5 years? Honestly, a lot of people end up in ULIPs that don't match their goals. They were either sold ULIPs by someone and they didn't understand the product wholly. Now, they wanted simple term insurance and market returns and ended up combining both of them in a not so efficient way. The 5-year mark becomes this checkpoint where they evaluate, okay, should I continue, partially withdraw, or completely exit? Now, the good news is from year 6 onwards, you have options. You can pull some money out for goals. You can cut losses and move investment elsewhere. But there's a catch that most policyholders ignore. Many insurers expect you to keep at least 1 year's premium, sometimes more, inside the ULIP to keep the life cover going and charges payable. If you withdraw too aggressively, you might unintentionally kill the protection part or force the policy into some awkward status. If you already know your ULIP is not great fit for long term, it can absolutely make sense to withdraw from the ULIP after 5 years and restrict and redirect your investment to cleaner vehicles like mutual funds. But please don't forget the life cover part. Before you exit the ULIP fully, make sure you've secured a dedicated term insurance plan. A term insurance plan gives you the same or higher cover at a much lower cost without any 5-year investment lock-in drama. You keep your protection separate from your investment, which is how it should have been from day one. If you're confused about whether to continue your ULIP, do a partial withdrawal or surrender, don't guess. You can book a free call with Ditto's advisors for a spam-free experience. Our services are completely free. Use the link in the description, share your policy details, and we'll tell you in plain language what makes the most sense for you. Alright folks, that was it from me. You're watching Ditto Insurance. Subscribe to us if you haven't already, and I'll see you in the next one. Until then, happy insurance hunting.